Let's get to the move you made this week. I mean, you reinstated your forward guidance, your projection for the official cash rate. You had paused that for a while. And as you did so, you took this opportunity to say it's possible, depending on the economy, that first rate hike could come by September of next year. Why now? What was driving this decision? Are you trying to make sure the markets are on the same page as the RBNZ?
We are always doing our very best to provide some guidance, some forward-looking markers for the public to be able to see, including financial markets, around how we see the economy unfolding, how we see inflation pressures unfolding, and hence, conditional on all of that, what we may need to do with regard to monetary policy. So yes, we've become more confident around a central projection, and that projection is one where we see inflation pressures finally, I would say, normalising, and one where we hopefully can be normalising the level of interest rates back to a more neutral level. There's a long time between now and the middle of next year, as we've seen, the way events develop. But that's our best foot forward at this point.
Is the virus, our vaccines, is this New Zealand's success at fighting the pandemic? Is this the main thing that's opening the door to saying maybe we could be hiking rates again if the optimistic scenario comes true?
Yeah, I mean, without doubt, the COVID-19 health implications are the number one drivers of uncertainty globally at this point. Very briefly, there's two parts to your question. The first part is, yes, New Zealand has been successful, touch wood, to date in containing the virus, and that has put us in a good starting position for the economy. We had this short, sharp -12 June quarter last year, +14 September. It's been, we're almost back to the level of output that we pre-COVID. So that's put us in a good starting position. But what's given us more confidence around talking about a projection is actually the global COVID position, where vaccines are being rolled out. The horizon can be seen. It's still some way off. But it's removing some of the most extreme, I would say, downside risks to the economic projections that all of us have been struggling with. So we're now in a more balanced manner. The confidence intervals are still wide, but we're in a position where we can say, look, subject to the COVID rollout, the vaccine rollouts as explained in our documents, and many other assumptions, we see improving conditions.
Well, if you do hike the key rate by 25 basis points in September, if you move it up to 1.5% by the end of 2023, which is also part of this official cash rate projection, you could be out in front of the Federal Reserve, because the Federal Reserve has not given any signal it's ready to the consensus to move their key rate up before end of 2023, 2024. Is this a concern? Could there be negative repercussions, like a currency that continues to strengthen?
I think relative economic divergences are always something we need to think about. Importantly, from our side, our activity is completely, largely in part determined by what is going on globally. So we really do need to see the global economic growth. We know that's been supported by very symmetry monetary policies, not just in the US, but around the world. So that is baked into our projections. We need to see that support going to make sure they really do anchor sustainable growth, to be purchasing our goods and services, and for tourism and trade to normalise. So that's a big part of it. How and if we get ahead of other central banks? Well, there's a lot of water to go under the bridge there. The financial markets, exchange rates in an economic sense should be reflecting relative inflation differentials and relative productivity differentials. And those, there's not a lot of divergence globally between that because of the common economic shock we've all received.
Well, then, do you have a sense that other central banks, like the Federal Reserve, are going to see what you see when you make this statement that depending on how things go, we could be raising rates as early as next year. Is it possible that your sense, having been a central banker for yourself for many years, that others, including the Fed, including maybe even the ECB, although the Fed seems like the likely candidate for maybe moving that up, especially since some Fed officials are already saying they would like to move it up?
Yeah, I think here it's just really important that, we have independent monetary policies because we have independent currencies and we're operating within our own economic environment. So I have full confidence that central banks elsewhere are thinking about their own domain, their own influence and what they need to do. For Aotearoa, New Zealand, given we're at a very strong starting point prior to the COVID, low inflation, very strong fiscal position, high levels of employment. We are in a position where we have recovered quicker, and touch wood that around the COVID issues that we may need to move ahead of other people. But I think a lot of this is going to be lost in the wash given the commonality of the challenge we all have.
Could I just put a finer point on this? Would it stop you? Would it give the RBNZ pause to start raising rates next year if others like the Federal Reserve have signaled that they're not ready to go?
No, we have to do the right thing by our remit for our country. And so, if we saw and believe that inflation pressures were getting too much, or that employment was very clearly at its maximum sustainable level, then that gives us great confidence to be able to shift more to a neutral interest rate position.
So let's look at something that's very definitely part of your remit. That's your dual mandate, inflation near target, a nice strong labor market. So will your projections show that inflation will not be up necessarily to target while you're thinking about maybe raising rates? So because you've seen this improvement, unemployment rate down to 4.7% now in New Zealand, faster than you had expected, that's the part of the mandate you're going to meet that again will put the key in the door and unlock that rate hike.
Yes, I mean, monetary policy always has to be forward-looking. I think a lot of, the discussions, I suppose there's two parts. Well, some central banks have put a specific date prior to which they said we are going to leave things unchanged. We have never done that. We've said, it's conditional on what we're observing. A key thing that we will be observing, of course, is that employment is at or very near its maximum sustainable employment level. It was at that level prior to the COVID, and we think there's still surplus. There's still unemployment beyond what it says level. So we're doing more mahi, more work in that space.
Are you seeing more wage pressures? I'm sorry. I want to jump in and ask you about wage pressures in the pipeline because of the tight labor market.
Yeah, well, we certainly are, but it's only in some sectors of the economy. This is a global challenge again. The first thing that many businesses tell us is labour shortages. Yet we know also, on the other hand, that there is unemployment. And so the variances between sectors of the economy and between countries worldwide are very large. On aggregate, we're saying there is surplus labour. But in some sectors, without doubt, there are skill shortages, particularly with immigration in New Zealand being very constrained for reasons. We are comfortable that you should see wage rising. That is the natural part of the labour market working, and it's also a natural part of the economy picking up wage growth to drive and attract labour specifically into those sectors. Our real challenge is how quickly can labour move? How flexible is that labour market from surplus areas to shortage areas and so on? So we will watch that, but we are not concerned about generalised wage inflation.